What's up, fellow real estate investors? Today we're talking about cost basis. How to go about calculating your cost basis and why is that important for you and I. Cost basis is instrumental in determining your capital gains tax, the tax liability you're going to owe to Uncle Sam when you liquidate your asset. And why is that important to you and I? Well, I know I want to minimize my tax liability to Uncle Sam as much as possible. I don't know about you guys, but I'm not a big fan of getting that big tax bill. So let's jump into it. We're going to be going over a case study in which we purchased an asset and then we subsequently liquidated several years later, and the asset appreciated and we were able to sell it for a greater amount than we had purchased it, and what kind of tax implications we're looking at as a result of liquidating that asset. Before we jump into the case study, I'm going to define a couple basic concepts that's important to understand when we analyze cost basis and capital gains. All right, we're going to be first we're going to be discussing the distinction between a deduction and a depreciation. Okay, a deduction is an operating cost, something that you incurred while throughout the course of the year and operating your rental business. Things such as snow removal or garbage sanitation disposal, those are operating expenses. The cost of those expenses will offset your net operating income to determine your taxable income for that year. You could then offset the entirety of that amount. If you had spent $5,000 in operating income in operating expenses that year, those $5,000 would offset your income for that year in its entirety. Now, the difference we're discussing is a depreciation. A depreciation is a capital expenditure and upgrade, something that has a lifespan. So the example we use to determine what a depreciation and a deduction is would be, for instance, repairing a roof as opposed to redoing the entirety of a roof. Repairing a roof would be a maintenance expense, such as patching a leaking roof. Let's say it costs you $1,000 to patch a roof. You would deduct the entirety of that $1,000 off your net operating income for that year to determine your tax liability. The distinction is redoing the entirety of the roof. If you had redone the entirety of the roof and it cost you $10,000, to determine how that would offset your income, you have to first determine the longevity of that upgrade, meaning the lifespan of that upgrade. So if it costs you $10,000 to redo a roof and the longevity of that roof is 10 years, you would then divide 10,000 by 10 years to determine that you're going to be depreciating that upgrade at a rate of $1,000 per year. Simple enough, right? All right, and something else I need to make certain you guys understand is that we are able to depreciate as real estate investors. We are able to depreciate the purchase price of our home. Now, this is one of the single most tax advantageous strategies real estate investors have to their disposal, which enables real estate investing to outperform the stock market. A lot of people will say, okay, the S&P did 12% for the year. Why would I invest in a 9% performing real estate asset such as a rental, for instance? The reason being is because of the tax implications. You're going to be paying capital gains tax on your 12% return on the stock market, as opposed to you depreciating your real rental asset, which will lower your taxable income. And you're going to be, once you've figured tax implications, real estate investing outperforms the stock market almost always. That's important. That's crucial, and that's important. And often, real estate investors underestimate that variable, the tax implications. To be a sophisticated, savvy real estate investor, you need to always understand your tax implications. And that's the variable you need to go into determining your profit and loss statements, is the tax implications. And real estate investing is one of the most tax advantageous strategies available to this country. All right, let's jump into that case study. All right, let's say we purchased a home for $400,000. Let me put it up there. Purchase price is $400,000. All right, so we're going to talk about depreciating the purchase price first, right? One thing before we jump into depreciating the purchase price, I need you guys to understand a very important topic, and that the IRS only allows us to depreciate the improvements of that purchase, not the improvements meaning the home itself, the building, the structure, the landscaping, such as paving stones, such as fencing. Those things are depreciable, the improvements on the land. The land itself is not depreciable because the IRS recognizes that the land does not have a longevity, it lasts forever. And you could only depreciate tangible assets that have a longevity, which is what the IRS guidance is, okay? So of that $400,000, which portion is land, which portion is improvements? So you would have to sit down with your CPA to determine this. This is a hypothetical case study. So let's put it up here. We're gonna say the improvements is $275,000, and the land is 125. Improve, and this is the land. Okay, so we're able to depreciate the improvements, and this is the formula for depreciating improvements. You take that number and you divide it by 27.5 years. That's the longevity of the home. Okay, that's what the IRS states. You can depreciate the purchase at the rate of 27.5 years improvements, right? So we're gonna put depreciate improvements. All right. So 275,000 divide by 27.5 years. We're able to depreciate the purchase price at the rate of $10,000 per year. Per year. All right. Now let's say also we did the roof that we discussed earlier. Let's say we went ahead and we redid the roof on this home. Okay. And we could depreciate that. Now, let's say the longevity of the roof is 10 years. So the depreciation of the roof would be $10,000 divided by 10 years, which would be $1,000 per year. So 1,000, we have a $10,000 depreciation there. We have a $1,000 depreciation there. Our net depreciation is $11,000 per year. Okay, we're depreciating $11,000 per year off our net operating income to determine our taxable income every single year. This number helps to lower your taxable income every single year. That's crucial. That's what real estate investors need to understand, how depreciation lowers your taxable income, and this is why it outperforms the stock market annually. All right, I'm going to leave this number up there, $11,000 per year, because now we're going to jump into cost basis and cap gains. All right, 11,000 staying up there, everything else is coming down. All right. All right, what's cap gains? Capital gains is a price at which you sold that asset in the end, subtracted by your cost basis. We need to get into cost basis to determine that, right? So let me put it up there. Your cap gains equals your purchase price. Your sold price. The price sold minus your cost basis. Your cost basis, man. We've been jumping around cost basis all day. What is cost basis? So let's get into it. What's cost basis? Your cost basis, all right? Your cost basis equals the price at which you purchased the house. That's your first variable, $400,000, plus whatever improvements you put into your home. We did the roof, right? At $10,000, plus $10,000 the roof, right? Minus your depreciation over those several years at which you held the asset. Now we need to understand that depreciation lowers our tax liability every single year, but it does increase the taxes we will incur when we sell the asset, because it's actually lowering our cost basis. The IRS wishes to recapture the depreciation. They call it depreciation recapture when you liquidate the asset. So they're looking to recapture the $11,000 per year, multiplied by the number of years you depreciated at. So let's say in our example, we held our asset for 2 years. So 2 years at $11,000 a year, we had depreciated $22,000 over those 2 years in our taxes every year. So minus 22K. All right, 400 plus 10,000. 400,000 plus 10,000 minus 22,000. What are we looking at? 410 minus 22 is 378. Oh no, I'm sorry, 388, right? $388,000, right? Wait, 4 times? Oh, 398. What am I saying? Oh, 388. Yes, 388. Our cost basis is $388,000, right? Now, to jump back, plug 388 into our cost basis over here. Our cap gains was the price sold. So what did we sell the price at? What did we sell this asset at? We had purchased it at $400,000. Let's say we sold it 2 years later at $600,000. That's a nice chunk of appreciation. Let's say we sold it at $600,000. $600,000 was our sales price, minus our cost basis, which was $388,000. Now our cap gains would be $212,000. Would be $212,000. There's our cap gains, $200,000. Our tax liability would be determined on gains of $212,000. So you could see here that we're depreciating at a rate of $11,000 per year, which is lowering our tax liability every single year. But when we look to liquidate the asset, it in fact increases our tax liability. So this is a strategy that's very important for you to understand, that depreciating every year will decrease your tax liability every single year. But if your strategy is to then liquidate the assets down the road, you will incur a larger tax liability as a result. So if you're a buy and hold investor and your strategy is to hold that asset for a long time and perhaps maybe defer the taxes till many years later, and by doing a 1031 exchange or jumping into one of the recently appointed opportunity zones, then perhaps you want to depreciate every year as much as possible. If your strategy is to flip these assets very quickly, you may not wish to depreciate as much as possible. These are strategies you need to discuss with your CPA. I presented them to you in a way in which real estate investors need to understand their options available to them. My name is Boris Portnov. I'm a licensed realtor in Jersey. I work with investors. My specialty is pinpointing distressed assets, and then I turn them around into performing assets. I'm a turnaround artist. You guys reach out to me if I can be of assistance to you. Thanks very much.
Fortnite.
Fortnite? What?